All right, welcome to this week's video market update for Market Matters. It's the 13th of October today. Market's been pretty choppy of late, James. We're going to talk about a couple of different themes within the market. Value versus growth, we've spoken about a lot of late. Growth's obviously outperformed pretty significantly, particularly out of this COVID rebound. What's the difference between value and growth, and how do you identify those pockets of the market?
Harry, it is a wonderful question, and obviously we've been writing about it a lot in recent times, and there's been a big sort of market conversation about the discrepancy between value and growth and what the impact of interest rates are on both of those areas of the market, etc. I guess the easy way I think to explain it is simply around high PE stocks versus low PE stocks. So stocks that have got a huge amount of upside, future upside built into them, would be classified as this high value growth, and stocks that are more have got less upside built into them, that are cheaper and more exposed to cyclical elements of the economy, are what we call value stocks. So I just touched on interest rates and the impact of interest rates. That's important because if you think about a growth stock where we're paying a high price for something now because it's going to earn a lot in the future. Whereas a value stock, there's not a lot built into the cake. So when you're valuing the longer dated earnings profile of a growth stock, the longer dated interest rate that you use is really important. So that in a nutshell is sort of the difference between value and growth. In a rising interest rate environment, value tends to do better than growth. In a falling interest rate environment, growth tends to do better than value. And since the GFC, interest rates have been falling. We're now starting to see them rise. And I guess that's why we've been writing and flagging this, shift in the market and shift in our portfolio positioning around that theme.
Yeah, definitely. So you're talking more shifting towards more value stocks. What industries and what specific names would we be targeting in that in those switches?
So I'll give a couple of examples of what a growth stock versus a value stock is, and also tie in. There's a really good example from Apple that has played out over the last decade or so. So examples of growth stocks we hold would be Hub24, for instance, or Xero. Xero, you go and look at the P multiple of Xero, and it's 1,000 times basically. It's reinvesting those earnings that they're generating back into the business to grow quicker. In FY21, Xero had revenue of 850 million. If you look out to FY23 on consensus forecast, that's going to have revenue of 1.4 billion. So clearly a lot of growth. If I go back and if I compare that to Apple 10 years ago, Apple in 2011 had revenue of 100 billion and profit of a lot less than that. This year, Apple's going to have net profit around 100 billion. So that's like it points into how you should be. That's why people, I guess, get optimistic on growth stocks. If you can grow the top line and you can manage margins, if you look 5-10 years down the track, you're going to have a hugely profitable business. And now Apple trades on 25 times earnings, which is a reasonable multiple relative to sort of the dominance that it's got. If I look at value stocks that we hold in the portfolio, one that springs to mind is NRW Holdings. NWH, it's a mining services company, capped about 800 million. It trades on 8 times earnings. So there's not a lot of optimism built into the future of that business. And there's a few reasons for that. Their earnings are very, they're slightly volatile. They are reliant upon winning contracts. So they're not as consistent as something like a Xero. They operate on fairly slim margins, so they've got to deal with things like at the moment they're seeing, they're experiencing some wage pressures and hard to get staff over there and whatnot. So that is a business that is not a lot priced in. Virgin UK, or the banks more generally, are sort of these value-orientated stocks. Virgin UK trades on 0.6 times book value. If I think of the Aussie banks, they trade on 1.4, CBA's on 2 times book. Banking stocks generally are considered value stocks. But then you go to the extreme, and Virgin Money is an extreme in that scenario. So they're probably the most obvious areas of value versus growth in our portfolios.
Yeah, definitely. You made mention, just quickly to wrap this up, James, you made mention of interest rates rising. We've started to see that sort of play out in the market. Doesn't the market sort of price in these future rate rises now and say that, okay, we know the Fed's telling us that they're going to raise rates, they're going to reduce tapering sooner than I think many expected. Is the market not pricing sort of that shift now, and why haven't we really seen those growth names pull back more significantly, and sort of that value gap between the value and growth names tightened a lot?
Yeah, really good question. So, I mean, the thing to look at in terms of future pricing or forward pricing of interest rates is the US 10-year bond yield. It's what the US borrow money for out 10 years. So, the bond yield's around 1.55% at the moment. So, in absolute terms, that's still really low. We've seen an upward move. If you look at, the bond yield based out just below 0.4%, and we now call it 1.6%. That's four times the the level of rates that have risen. So obviously that's a big move, but in thinking longer term, it's obviously not. The absolute yield is still relatively low. So, when we think about portfolios around that, I don't think it's a case where we're not going out there and shunning growth, but we're being more selective in growth. We're not only targeting value stocks, but we're being more, we're going to increase the weighting of value stocks in our portfolio, if you like. So it's just around our thinking around portfolio positioning. We write about it a lot, so I thought it'd be worthwhile doing a video to sort of explain our thinking around that key concept moving forward.
All right, definitely. Thanks for joining us, James. I'm pretty excited to catch up face to face.
I've just got. There's a bit of noise in the background. My mum and dad have just arrived, and they've just seen the kids for the first time in a few months. So that's the noise in the background that people can hear on the video there. So better go out and see the mum and the dad.
Face is back. Good on you.
See you guys.